Happy Monday and welcome back. I'm Amber with this week's Q&A. When does Fannie Mae require federal income tax returns to document income? When one of the following income sources are being used to qualify: commission earnings that amount to 25% or more of the borrower's total employment income, employment by a family member or an interested party to the purchase transaction, rental income from an investment property if acquired prior to the most recent tax filing, income from temporary or sporadic employment, for example, seasonal income, income reported on IRS Form 1099, for example, capital gains, royalties, income earned from a foreign corporation or foreign government and paid in foreign currency, income earned that cannot be otherwise verified by an independent and acknowledgeable source, income from interest and dividends, income from self-employment defined as 25% or more ownership in the business, and income reported to the borrower on the Schedule K-1, regardless of percentage of ownership. In these cases, the tax returns provide the underwriter with a more comprehensive view of the borrower's income and enable identification of any related expenses that may need to be factored into the income calculation. For a complete list of income sources and required documentation, please refer to B3 Income Assessment in the Selling Guide. Now on to the next one. Can I exclude the credit report mortgage payment history if my borrower is separated but not yet divorced? Yes. Depending on the date of the court-ordered assignment of debt, prior to that date, the borrower would have a liability to the creditor. After that date, the lender can disregard the borrower's payment history for that debt. And for the last scenario, is using future income allowed for Fannie Mae financing? Absolutely. Non-delegated purchase transactions can be underwritten using future income under the following conditions. Borrower is qualified using only fixed-based income, for example, non-fluctuating salary or hourly wages. The employment offer is non-contingent and is fully executed by the employer and accepted by the borrower. If there are contingencies to the offer, any contingencies or conditions of employment must be satisfied prior to closing. The employment offer letter or contract must clearly identify the terms of employment, including position, type and rate of pay, and start date. Must not be employed by family member or interested party to the transaction. Employment must begin within 90 days after signing the note. Adequate income and or liquid assets to pay the PITIA and all other monthly liabilities between the note date and the start date of the new employment. Plus, an additional 1 month reserves are required, or reserves covering PITIA for 6 months. And a 10-day pre-closing verification of employment, verifying the terms of the employment offer, contract, or future salary increase have not changed. And that is it.